Good morning, students. Today we are going to see how to calculate weighted average cost of capital using market value as the base. Normally, the companies may raise finance from a number of sources, namely equity, preference, debenture, and so on. All these different securities are expected to generate different returns. By using weighted average cost of capital, what is the minimum rate of return that the company must earn to satisfy all its investors, and what is the rate that the company is expected to pay on an average to all its security holders can be known. To calculate weighted average cost of capital, the relative weight of each component in the capital structure are taken into account. The weights may be either of book value or market value. Normally, the market value of weights are operationally inconvenient, especially for market value of the resource. But market value of the resource can indirectly be estimated by allocating the total market value in the ratio of book values of equity shares and reserves. The individual market value of equity share and reserves can be determined. Cost of reserves are approximately equal to the cost of equity capital with an assumption of external yield criterion. What I mean by that external yield criterion, it is nothing but external investment opportunity for the investor and for the company by investing their reserves or retained earnings elsewhere. However, the cost of reserve would be slightly lower than the cost of equity due to the cost of flotation and the rate of tax. So this is the formula to calculate cost of reserve. So cost of reserve equal to cost of equity into 1 minus brokerage or flotation cost into 1 minus T. Let us see the example how to calculate the weighted average cost of capital taking the market value as weight. See, in this problem, the total market value of equity and reserves and surplus is 4,50,000. So how to bifurcate this 4,50,000? That can be bifurcated in the ratio of 2,50,000 is to 1,50,000 for equity share capital and reserves and surplus. So this 2,50,000 and 1,50,000 is nothing but the book value of the equity capital and reserves and surplus. Let us see how it has been bifurcated. Total market value of the equity is how much? 4,50,000. What is the ratio? 2,50,000 is to 1,50,000. This is nothing but the book value. So it can be simplified as 5 is to 3. Now calculate the market value of the equity capital. In 4,50,000, the portion of equity capital is 5 by 8. You will get a figure of 2,81,250 as the market value of equity capital. What is the value of market value of reserves and surplus? 4,50,000 into 3 by 8. This is the 1,68,750. In this way, I have calculated the market value of the equity and reserves and surplus. Now coming to the calculation of weighted average cost of capital. To calculate weighted average cost of capital, each specific sources of finance cost has to be identified. What are all the sources of finance, specific source of finance here, given here? Equity, preference, debenture. First we will calculate the cost of equity. To calculate the cost of equity, what are all the information given to you? Dividend per share is given to you, and the growth rate is given to you, and you know the market value, and you know the number of shares, and you know the face value of the share. Now you can apply this in the formula. To calculate the cost of equity, D divided by MP plus G. This formula can be used to know the dividend value is given to you as 2.40. What is the growth rate? 15%. That is also given to you. You do not know the market value of share. So the market price per share to be calculated. How to calculate this? On the whole, the market value of the equity is taken into account, 4,50,000. it is to be divided with the number of equity share 25,000. Why I am taking the total market value means with the help of the cost of equity we can arrive this here. With the help of the cost of equity we can arrive the cost of reserve. So to calculate the cost of equity I am taking the on the whole the market value of the equity as 4,50,000. So 4,50,000 is the total market value divided by number of equity shares. It is given here as 25,000. When you divide this you will get rupees 18 as the market price per share. Now apply all these values in the formula. You will arrive the figure 28.33% as the cost of equity. Now coming to the next specific sources of finance, preference. This preference shares are the redeemable preference shares. You see the preference share capital is market value is 45,000. Its rate of interest is fixed as 13%, but it's given here is the preference shares and debentures are redeemable. What do you mean by this redeemable? It is repayable. After the 50th year, this preference shares to be repayable to the preference shareholders. After how many years? After the 50th year, this is to be repayable. This amount has to be repayable to the preference shareholders. Now coming to the calculation of the cost of preference. This redeemable preference, this formula to be applied. To apply this in the formula, D is the dividend for preference shares, RV is nothing but the repayable value of the preference shares, net proceeds. Here you instead of net proceeds you have to apply the market price because you are taken the base as the market value and N is the number of years. So now calculate the dividend for preference share. What is the face value of the preference share? 10 rupees. What is the rate of dividend? It is fixed as 13%. So 10 rupees into 13%, you will get rupees 1.3 as the dividend per share, dividend per preference share. What is the market value of the preference share? What is the market value? Total market value of a preference shares 45,000. So here 45,000 it is the total market value of the preference capital. Now to calculate the market price per preference share, 45,000 to be divided by 5,000. What is this 5,000? 5,000 is the number of preference shares. Now by dividing these two you will arrive a figure rupees 9. This is the market price of a preference share. Now coming to the repayable value of a preference share. If this is rupees 10. Why I am taking this rupees 10? Because no information is given to you. It is redeemable at what value? Whether it is a premium or a discount is nothing has been mentioned here. So I am assuming that the repayable value is the face value. So I have taken this rupees 10 as the repayable value. N is 5 years. That is the number of years. After 50 year, this preference share capital is redeemed. So I have taken 5 years as the N. Now apply all these values in the formula. So 1.3 is the dividend. 10 is the repayable value, 9 is the market price, divided by 5 is 5 is the number of years. So 1 point and here 10 plus 9. So this is the formula RV plus NP. So 10 is the repayable value, 9 is the market price. On the whole it is divided by 2. So instead of multiplying by 1 by 2, I am just dividing by 2. So now calculate 1.3, 10.9, 10 minus 9 divided by 5 will give you 0.2. So 1.3 plus 0.2 divided by 9.5. How I have got this 9.5? 10 plus 9 divided by 2 will give you 9.5. So you add these two, 1.3 plus 0.2 divide by 9.5. You will get this figure 0.15789. This is to be multiplied with 100 to say 18%. So cost of preference is 15.79%. 8%. Coming to the cost of debenture, so debenture is also a redeemable debenture. And after how many years this debentures have been redeemed? After 6 years. See, the debentures are redeemable at par after 5 years and 6 years. So the debentures were redeemed after 6th year. What is the market value of the debenture? 1,45,000. What is the rate of interest of the debenture? 14% as fixed. How many debentures were issued? 15,000 debentures. What is the face value of the debenture? Rupees 10. Now coming to the calculation of cost of redeemable debenture. To calculate the redeemable debenture, we are applying the after tax. That is, the tax rate is applicable here because the debenture is a borrowed fund. So after the debentures interest only, we are calculating the taxes. So the tax rate is applicable here. To calculate the cost of debenture after tax, this formula has to be taken into account. I is nothing but interest into 1 minus T plus RV is the repayable value minus NP. NP is the net profits. Instead of taking net profits, we are taking market price because we are assuming we are taking the market value as the base divided by N. N is the after how many years these debentures were redeemed. We divided by 1 by 2 into RV, repayable value, plus net proceeds. Instead of net proceeds, we are taking market price. Now to calculate now you calculate the interest. Interest, I is the interest. Interest is how much? What is the face value of the debenture? What is the face value of the debenture? Rupees 10. What is the rate of interest? Rupees 14. 10 rupees is the face value. Rate of interest is 14%. When you multiply these two, you will get 1.4. You have to uh, to calculate the after tax rate, this 1 minus T to be applied here. What is this T? T is the tax rate. The tax rate is 30% is given in your problem. So 1 minus T, 1 minus 0.30. How I have arrived this 0.30? 30% has been written like this, that is 30 divided by 100, you will get 0.30. 1.4 into 1 minus 0.30, you will arrive a figure 0.98. That is rupees 0.98 is the interest payable for one debenture. Now coming to the market price of one debenture. So what is the market value of the whole debentures? 15,000 debentures, 1,45,000. To get a market price of one debenture, total market value of the debentures is divided by number of debentures. How much is the number of debentures? 15,000 debentures. So 1,45,000 divided by 15,000, you will get rupees 9.67 as the market value or market price of one debenture. What is the repayable value of one debenture? Rupees 10. It is the par value. Nothing has been specified whether the debentures are redeemable. So it is specified redeemable at par value. Redeemable at par value. So I am taking the rupees 10, that is the par value, face value, as the repayable value. N is how much? Number of years is 6 years. Now calculate now apply all these values in the formula. 1 I into 1 minus T. It is how much? Interest 0.98. What is that interest after payment, after taking into account the tax? How much is the interest payable to debenture holders? 0.98. Normally they are getting 1.4 as the interest, but after applying this tax rate, the actual rate of actual amount of interest payable to the debenture holders is 98 pice only. plus this repayable value 10 minus the market price 9.67 divided by 6 is the number of years. When you apply this, all these values in the formula, you will get the cost of debenture as 10.52%. Coming to the cost of reserve, no, you have seen this how to calculate this cost of reserve in the previous slide. Cost of reserve equal to cost of equity into 1 minus brokerage or flotation cost into 1 minus T. The same formula I have applied here. What is the cost of equity? You have calculated earlier as 28.33% that you take into account into 1 minus B. There is no brokerage cost spent here, so I have left that. I have taken only the 1 minus T. What is 1 minus T? T is the tax rate, 1 minus 0.30. When you multiply 1 minus 0.30 will give you 0.70. Multiply this 0.70 with 28.33%. You will arrive a figure of 19.83% as the cost of reserve. To calculate weighted average cost of capital, now you write you take all the sources, namely equity share capital, preferential capital, reserves, debenture capital. For equity share capital and reserve, I have already calculated the individual market value of equity share capital and reserves in the previous slide itself by applying the ratio. So that I have taken into account, and to calculate the weighted cost proportion to be calculated. How to calculate this proportion? 2,81,250. This is the portion of the equity. This is to be compared with the total investment, that is 6,40,000. When you compare this 2,81,250 with 6,40,000, you will get the proportion 0.43. This proportion to be multiplied with the after tax cost. This earlier in the previous slide itself we have calculated. So this is to be multiplied with the proportion and after tax cost portion to be multiplied. So 0.43 into 28.33%, you will arrive a figure 0.128. In the same way, the preference share capital and for reserves and for debenture capital, these two figures were multiplied to arrive this. So when you multiply 0.07 into 15.79, you will arrive a figure 0.0110. And when you multiply 0.26 as the portion of reserve to its after tax cost, you will arrive this figure 0.0515. So in the same way, the proportion of debenture capital is to be multiplied with its cost 10.52%. You will get a figure of 0.0238. When you add all these weighted cost, you will get 20.81% is the weighted average cost of capital. So this rate has to be paid to the all its providers of capital, namely equity shareholders, preference shareholders, and to the debenture holders. So this is the weighted cost to be paid to the all the providers of capital, and also this is the minimum rate of return the company must earn for the total investment 6,40,000. I think you are all clear with this. Thank you, students.